Hi, Greg Lewis, Metastock Software. You're about to watch one of the presentations from the 2017 Online Traders Summit. I know you're going to enjoy it. Before we begin, I want to tell you just a little bit about us here at Metastock. We've been in business for about 30 years. Metastock is about the most powerful platform you can get for the private trader anywhere. You can test, you can scan, you can forecast, you can customize to your heart's content. It's an amazing piece of trading technology. If you'd like to get a free extended trial of Metastock, I encourage you to go to metastock.com/traders-summit 3-for-1. That's metastock.com/traders-summit 3-for-1, or just click one of the links provided, and you can get 3 months of Metastock for the price of one. That's an amazing deal. I encourage you to do so. I know you won't regret it. Please enjoy the presentation and successful trading.
Vlad Karpel is a very nice guy. We've been working with him a lot. He runs a service called Tradespoon, and he's done some really cool things inside of Metastock, and he's going to show you those. And let's go ahead and bring him on here. Hey, Vlad, let's go ahead and get your audio working.
All right. Can you guys hear me?
I can hear you.
Excellent.
You sound great to me.
Excellent. Great. Can you see my screen?
I can.
All right.
And I know we're about 6 minutes late. If you go a little bit long, you're the last speaker. It's not going to be a big deal. So let's go ahead and let you go.
All right, Jeff. Thank you very much. I want to say thank you to Jeff for having me and other speakers. This is my first live event with Metastock, so I'm excited. And today I want to talk about key trading metrics. If you trade stocks, options, or ETF, I think you had several speakers today talking about options and how important they are. I want to talk about several characteristics of that you can derive from options and stocks, such as return on capital, probability of success, and estimated move. And at Tradespoon, we believe in statistics. Every decision we make, every tool we make is done based on statistics. And for those of you, I see some familiar names, but for those of you who are new, this is my brief bio. I was the Executive Vice President and Head of Technology at OptionsXpress from 1999 through 2007. For those of you who are not familiar with OptionsXpress, this is an online broker-dealer which was acquired by Charles Schwab in 2011. The company went public in 2005. I was their first employee, and at some point the company was worth over $2 billion. So I'm very proud about that experience. Since I left OptionsXpress in 2007, I worked as an investor and consultant in several financial technology firms here in Chicago, several startups, Groupon, one of the better names, Mediaocean, several hedge funds. So that's where majority of my experience come from. That's what I'm passionate, is working for startup companies. I've been managing and trading my own money for over 15 years since I joined OptionsXpress. One of the main reasons why I joined OptionsXpress, I was always fascinated by options and futures. I've been teaching and mentoring Tradespoon subscribers how to trade stock and options and ETFs for over 5 years. I encourage you to visit our site, tradespoon.com. We have a lot of free educational content that talks about stock, options, futures, video, and written content. We spend a lot of time and money building this content, and I'm very passionate. I come from a family of teachers, physics and piano teachers and mathematics. And finally, I have a master's degree in computer science. My background is artificial intelligence, statistics, and we have a team of financial engineers that are building new models and enhancing existing models. So I'm very thankful to Tradespoon. It gives me opportunity to have flexibility in schedule, can travel and spend more time with my family, but also do what I really enjoy professionally, managing the money, trading, and building great technology. And as Jeff alluded, I will at the end show what we have done with Metastock in terms of some of the models that we incorporated now inside Metastock. Since I'm going to go through some live trading examples, I want to make sure that we take a second to look at the disclosures. Trading stock and options involve risk and are not suitable for everyone. You can look at you can find the characteristics of option trading at optionclearing.com. And you must be aware of the risks and be willing to accept them in order to trade in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own portfolio based on my own risk tolerance level for general education and information purposes only. Please consult your own financial advisor prior to making any trading decisions. And also, it should not be assumed that the future trade picks will be profitable or will equal past performance. So I want to kind of take a step back. As I said, we spend a lot of time in education. If you go to our video archives that are available for everyone, it's part of our free membership. If you go to tradespoon.com and just type in your email, you'll be able to access this live webinar recording. And we basically build our system based on the 7 pillars of successful trading, profitable trading. And those 7 pillars you can see on the screen. One of the main pillars is answering the question what to trade. Some people like to trade futures, some people love options, forex, ETFs, stocks. So you need to pick the asset class that you like to trade and you're comfortable with based on your own trading psychology, and learn how it behaves during macro and microeconomic events. The second pillar of successful trading is position management. You need to know when to close your position, when to enter, and when to exit your position. And at Tradespoon, we build all of the technology to address these 7 pillars of successful trading. You want to avoid chasing the market. Very often, one of the common mistakes are that you're chasing the market. If the market going higher, we've been in 8 years of bull market, and we see a rally. People tend to chase and pile up into the trend. So you want to make sure that you always have your favorable trading setup. One of the key in being successful in trading, to learn to find your favorable setup, trading setup based on the technical or fundamental or combination of technical and fundamental analysis, and analyze what your risk versus reward ratio. And we're going to talk about it shortly in terms of how to calculate risk and reward when you trade stock and options. And you want to make sure that you document that in your trading plan, and you have the ratio between the maximum risk and maximum reward is favorable. And you want to do this before you enter into a trade. One of the most common mistakes that new traders do is that they enter in a trade and they don't have clear decision-making process in terms of when they're going to exit the trade. And that has to be documented, and that decision has to be made before you get into the trade. You need to be patient and maintain long-term focus. Ultimately, everybody on this call have a reason why they're trading, what their daily, weekly, and monthly goals. You need to document those goals in your journal and write it down and make sure that you have a long-term focus. And when you reach your daily or weekly goal, potentially scale down your position and trade less to avoid losing the hard-earned profit that you have done. Very important to know how to manage positions and hedge your portfolio. We spend a lot of time at Tradespoon talking about different strategies of how to hedge your portfolio and ultimately know what your maximum drawdown in your portfolio, what is the risk in individual positions, and what is the risk across all of your positions in your portfolio. And we talked about managing risk and reward, very important. And again, cement your rules, write them down, and make sure you stick to those rules. And those, all of the 7 pillars of successful trading, we have it documented in our manuals, the trading manuals, and we also have them as a video if you search our video archives. So, as I said, one of the most important characteristics is know what to trade, but also understand how to find these key support and resistance levels, right? In order to calculate your risk versus reward ratio, you need to know where the stock is trading, what is the trend, is it sideways, is it trending up, trending down, and at what point do you enter and exit your position. So we have a tool that you can see here, it's called Stock Forecast Toolbox, that can help you determine where the stock or ETF or future is trading in the next 5 minutes, 10 days, and 1 hour. And I can show you this tool here. So you can type in spiders, or you can select a futures, and basically, or Forex, we have different products. And we have a model that will run. And basically here we're looking at S&P mini futures September contract that shows you basically right now the futures are in uptrend. We show a slight uptrend in the next 10 days. And for Monday, we're predicting that S&P mini will trade between 24.58 and 24.72. So my favorite setup is where you show a positive vector. It means that the trend is positive, slightly positive, and as long as the market is trading above 50-day moving average, right now the model shows that the path of this resistance is to the upside. Obviously, we do have different geopolitical risks, news from hurricane and unfortunate events that are happening right now in Miami, geopolitical risk from North Korea. So those events can create a new information, and the model will have to adjust. But as of right now, as long as the market above 50-day moving average, the model basically detecting that the trend of the least resistance is to the upside. And based on this model, we can do the same thing for spiders. It shows you where the stock or ETF, you can type in any ETF, any symbol on any exchanges. It basically shows you what the support and resistance levels are and what is the trend. Also very important, I'm going to show it towards the end of the presentation, is that we have model and we have probability. Any type of signal that you will get, ultimately any chart patterns, whether it's ascending triangle or descending triangle, very important to answer the question, not because different stocks behave differently due to different patterns. But you need to know, based on the backtest, for this specific symbol, whether it's Apple or spiders or Microsoft, when this pattern occurs, whether it's ascending triangle or whether there's some kind of a crossover, or you're looking at the Ichimoku cloud, whatever the technical indicators, you need to have a knowledge and information that says when this signal occurs, how often the trade goes in your direction. Is it 60% of the time, 80% of the time, 90% of the time? So at Tradespoon, we are able to achieve 70%. Some of the stock, if you look like Oracle, we have 80% probability that if we predict that the stock is trading in an uptrend, right? If we see that Oracle is trending in an uptrend, then once it reaches our predicted low, once it reaches our predicted low, 75% of the time it will close above that level. So when we generate signals, we always assign probability that tells you, based on the last 60 days, 90 days, how often does the stock will close above that point. And it's very powerful information that can help you become a more successful trader. And these predictions we have for 1 hour, for 10 days, for 6 months, for almost any type of trader, whether you're a day trader, or swing trader, or long-term investor. You can go in and type in the symbol and provide these predictions. So now that you have these predictions and you have the tools, or you follow a different chart patterns, how can you take advantage of this information? So at Tradespoon, we provide part of our premium service, we provide exposure to our portfolio. So and in that portfolio, we trade options. And we give you a choice. You can trade options, you can trade option spreads, you can trade butterfly, RM condors. I personally trade spreads. So the portfolio that I manage and we expose to our premium subscribers, I trade option spreads. So on your screen, you can see that if you have a bullish sentiment based on the model, let's say Oracle, you're in bullish sentiment, Oracle announced earnings, you think that NASDAQ stocks will continue its uptrend, that they outperformed the market in the past year, and you want to get into a position in your time horizon October or November. So you can express your bullish sentiment, you can trade call spreads, bullish call spreads, or you can trade credit put spread. And the performance of that, the profit and loss diagram that you can see on your screen is the same, right? You can see that if you have a lower strike of your long call, you have a higher strike of your short call, and ultimately you have maximum loss, right? One of the characteristics of spreads that you have well-defined loss and well-defined profit. And that works great in the environment like we have right now, where there is a lot of uncertainty in the market. You don't have unlimited loss like you have with stocks or short calls, short puts. You have well-defined characteristics in terms of risk versus reward. You also have this bell-shaped curve in terms of probability. Just like a Tradespoon, when you generate the signal, you want to know whether you're 75% correct or 85% correct. When you trade your spreads based on the implied volatility, you can also determine what is the probability that this trade will be will go higher or will be lower and will be successful. So if you don't, I guess just a quick question, how many of you, when you trade, and it doesn't matter what you trade, whether you trade stocks or indexes, futures, how often do you actually look at the statistics? How often do you stop yourself and ask yourself, will the future trade in this range by this time? Is there a 60%, 80% probability? Just wanted to see if any of you even look at the concepts like delta, option delta, or if you don't trade options, just ask yourself, I'm looking for 2% gain in the next 30 days, or in the next 5 minutes, I'm looking for 0.5% gain. Do you stop yourself and ask yourself, what is the probability of that event? Is it 70%, 80%? So just wanted to see if you guys can give me. Perfect. So some of you said yes, some of you said never. So a lot of people say I do great. A lot of people say no. If you say no, then I want everybody hopefully to get at least 2 things that will make you a better trader from this presentation. If you said no, very important. Hopefully by the end of this presentation, I will change your mind, and from now on, when you do trade, you will have tools and you will have knowledge to always look at probabilities. And the screen that you see on your, just a little background, when you look at the statistics and when you look at the trading follows statistics. At any given point of time, you can determine where the stock will trade in what price range. So going back to our algebra class or our statistics class, if the stock is trading at a certain level, right, like Apple is trading at, let's say, 150. You can, with a high certainty, determine where Apple is going to trade next Friday, 2 weeks from now, 1 month from now. And there are different tools. There's a historical volatility that looks at historical data. There's implied volatility that you can derive from option data, where with a high certainty, I can tell you where Apple is going to trade by next Friday by looking at the options data or by looking at Tradespoon forecasting tools. But statistics can tell you with a 68% certainty, and we refer to 1 standard deviation, that the Apple will move maybe by 1% in the next 5 days. So if you never ask yourself the question or you never use tools, you should always ask yourself, how long do I hold the position and where do I think the stock is going to trade by that time? And that clearly determines the support and resistance where underlying asset class will trade. And it doesn't matter whether you trade in gold, oil, or S&P mini, or you trade in ETF and stock, the process is the same. With 1 standard deviation, there's 68% probability that the stock will remain in that price range, U minus Q, that you can see on your screen, and U plus Q. If you want to be more certain, then you can determine with this 2 standard deviation, 95% of the time, that the stock will trade between 2 standard deviation. And let's look at an example. Here I'm pulling up the chart. Let's look at, let's say, Apple price chart. So here you can see the Apple price chart. And let me see, price chart. Let's see if I can detach this. All right. So here I'm showing you Bollinger Bands, right? So I'm not sure if you're familiar with Bollinger Bands, but Bollinger Bands rely on the historical volatility. So historical volatility basically looks at the past data. Implied volatility, it looks at the supply and demand of option data and the future volatility. Because what this chart shows you, it basically shows the bands, right? Whether you use Ichimoku bands or Bollinger Band, whatever the bands, oscillators you're looking for from technical analysis, you can basically say that with 95% certainty that the stock market will remain between the upper and lower Bollinger Band. And you can see that we, for the since the election, we are constantly trading between the 50-day moving average, which is the middle line, and the upper band of Bollinger Band, because we're in bullish market, and 95% of the time stock market remains between these two bands. So you know every time we reach the upper band, the stock market is overbought, and most likely at some point it will pull back and will stop at the 50-day moving average, or sometimes it reaches even the lower Bollinger Band if there is some kind of a geopolitical events in North Korea or Brexit. Then you know that, or during elections, these events will cause the stock market to stop at the lower Bollinger Band. So this is, so whether you right now you're looking at 1-year chart of S&P or Apple, sorry, 1-year chart of Apple, and that's what statistics tell you. It basically says that 95% of the time the stock will remain between these bands. There's always outliers, right? There's 5% of the time due to some geopolitical or macroeconomic events such as earnings, the stock might trade outside of those range, and those we call outliers. So that's very important information to know. I'm looking at the 1-year chart, but with the historical volatility and implied volatility, you can do the same analysis for 1 day, for 7 days, for 14 days, looking at the option chain data and implied volatility of the options. So why is this important? Why do I need to care? A lot of people said, no, I don't look at the statistics. So very important to understand that when you going back to your class, and we all did these experiments rolling dice, right? You're rolling 2 dice, and you want to know how often do I get 12? How often do I get 2? If you're actually going to use this information to go to casino and play craps, if you don't look at the probabilities, most of the time, 99% of the time, you'll probably lose playing craps, right? Or you probably, if you don't look at the statistics and you have to answer, you probably fail your statistics class. So trading is the same thing. Whether you're in your statistics class, whether you're at the table playing craps, or if you're trading, if you don't ask yourself what's the probability when I roll 2 dice of receiving 7, if you intuitively don't realize that 7 comes out more often than any other number, then you basically trading against the trend, right? You're trading at a disadvantage. And trading stocks and options and ETFs is the same thing. So here, when I roll 2 dice, you know that 7 will come out roughly 17% of the time, and 6 and 8 will come out 14% of the time. So if I want to ask myself a question, 50% of the time, which numbers will come out? Well, I just add these probabilities, right? 7 comes out 17%, 6 and 8 comes out 14%, so 14 plus 14, 28, 28 plus 17, roughly 50% of the time, right? So 50% of the time, 6, 7, and 8. So I know if I want to be 50% of the time, then I need to answer 6, 7, and 8. If I want to expand my success rate, well, then I have to include 5 and 9, right? Then I have to say, well, 5, 6, 7, and 8, and 9 comes out, 70% of the time. When I look at the probability where stock is trading, it's the same thing. You can look at the stock forecast toolbox, you can look at the traditional technical analysis or option data, and with a high certainty, I can tell you where Apple is going to trade tomorrow, in what range it will trade, and I can actually tell you where Apple is going to trade in the next Friday. And that's exactly what we're doing when we do this analysis in the stock forecast toolbox, right? We're analyzing stocks, and we give you the band, right? We'll tell you what is predicted high and low for the next day is. Let's say for Oracle, we're telling you, well, this is monthly. Let's look at the 10-day prediction. So with a high certainty, I can tell you that Oracle on Monday will trade between 51.58 and 52.98. It doesn't mean that both extremes will be reached, right? I don't know what's going to happen with the hurricane. If it's a devastating event and it's Category 5, and a lot of oil stocks, a lot of the financial stocks will be affected adversely. Hopefully, with everybody's prayers, the hurricane will be of magnitude 3 or 2, and hopefully maybe bypass Florida, and then there might be a rally in the oil stocks. Since the outcome of these events are not clear and nobody knows them, then you can't really say that the both low and high will be reached. But we do know that 90% of the time, the stock will remain trading between low and high, and based on the past performance, I know that if Oracle reaches 51.38, if Oracle reaches 51.38 on Monday, then 75% probability it will close above that price. And that gives me an idea that this is where I want to enter my trade. So probability of success is a very important concept. This is, I'm looking at the probability calculator, most broker-dealers. If you want to answer a question where stock or ETF is going to trade by Friday, you can go to any of the broker-dealers that offer options data, and you can go to probability calculator. We have a probability calculator at Tradespoon, and you can enter a symbol, and it gives you very important information. It basically tells you that in the next 50 days, and let's do this actually with live example. Let's look at the Apple. Right, I can go in, probability calculator, type in Apple. And basically, in the next 50 days, so now we're looking at October expiration. So between now and 3rd Friday of October, with a 60% certainty, I know that Apple will trade between 144 and 172, right? So when I put my stop orders and when I put my limit orders, if I put a limit order of selling Apple at 172, then I know there is only 20% chance that it will reach that level. If Apple announces in the next couple of weeks the new Model 8 and everybody buys Model 8 and people wait 68 hours in line to get the new Apple, well, it can reach that level, right? Potentially it can reach that level, but statistically speaking, only 20% chance that it will happen. So maybe your expectation for Apple reaching 172 are unreasonable. So if you trade in options, right, when you talk about options, then potentially maybe instead of buying 170 call or 175 call and only having 20% chance that the stock will reach that level, maybe it makes sense to sell a call, right, to hedge yourself. Because only 20% chance, or if you're really bullish on the stock and you don't have a strong direction, bias in direction, maybe it makes some sense to sell 145 put. If you're bullish on Apple and you want to sell 145 put, you know that between now and 3rd Friday of October, there's only 20% chance then the stock will reach that level. So you want to short a put, express your bullish bias, or sell credit put spread like we do at Tradespoon in our expert pick portfolio. You would sell a credit put spread because you're bullish on Apple and you wanted to express your bullish opinion. And this trend number is very important. It's another number, it's another model that we run that makes independent decisions about where Apple is going to spend its time in the next 20 days, 30 days, 40 days, and 50 days. And if 3 out of 4 predictions are higher that you can see on your screen, then looking at the accuracy, we are able to achieve 80% signal. And if you talk to, I have a lot of friends and colleagues that are running hedge funds, and I spend all the time. If you're looking for long-term signals, doesn't matter what patterns you use or what, Ichimoku cloud, ascending triangles, head and shoulders, it's great. The question becomes, how accurate is the head and shoulders for Apple when you see, descending inverse head and shoulders? If you cannot run the model and tell you what the accuracy of those predictions are, then you basically are kind of on your own. It could be a great pattern, but it might only work for Apple 20% of the time. Then why would you ever execute this trade? And most retail products don't have the money or don't have the level of sophistication to actually show you these accuracy numbers. At Tradespoon, we believe in leveling the playing field and operate just like any other big hedge funds, and we're able to give you accuracy of 80–84%. If you talk to any of the hedge funds, especially that works on statistical arbitrage, most of the big hedge funds cannot achieve. They're very happy with 70%, 65%. We're talking about long-term signal. For 50-day signal or for 2-3 month signal, achieving 70-80% is very difficult. We are Tradespoon actually able to achieve not on all symbols, right? We're not saying that I can predict any symbols with 80% accuracy, but some of the symbols that follow a well-defined pattern, whether it's a seasonality pattern or whether it's traditional chart patterns, we're able to find out the pattern and give you an accuracy of 80%. So if you see 3 out of 4 predictions, independent predictions, higher, then you can look at the accuracy and it gives you 80% accurately that Apple in the next 50 days will be higher than it currently is. And this model runs every week. So if I know that the next 20, 30, and 40 days prediction is higher, I know that Apple is about to announce new phone. Then if I want to express this bullish bias, again, I'm going to look at the statistics. I'm going to see, well, there's only 20% chance that Apple will sell off to 145, and I can sell 145 put spread. I can determine that support, and I know what the probability based on implied volatility, based on option data, what the probability is, and based also on Tradespoon model, where the trend is for the next 50 days. So probability of success is very important. Again, once you have probability of success, the question becomes what strike price do you select? Or if you trade stocks, you want to figure out at what key level is the support and resistance. So when you enter your trade and you do the calculation between your risk and reward, you have a very favorable setup in terms of risk and versus reward. And I do encourage you guys to enter a lot of questions. I see a lot of questions. I'm going to make sure I will answer all of your questions, but I do want to go through the material. It's 4:37 Central, 5:37 Central. I'll probably have another 20 minutes. So I'm going to spend another 10 minutes maybe covering the content, and then I'm going to make sure that I answer all your questions. So please enter your questions. I'm not ignoring them. I just want to kind of cover the material and then get back to your answers. So I briefly mentioned volatility. Volatility is very important because sometimes I would get a question from the members saying, Vlad, you predicted Oracle to be, or Apple to be at 145. And you know what? Apple, makes an announcement about iPhone 8, and nobody's buying iPhone 8. Everybody loves Samsung. They have a new Samsung phone, and it's faster and better camera. And all of a sudden, Apple sells off, and it's all of a sudden trades by end of October at 140 level. And I would get emails and support tickets saying, well, the model just doesn't work. You have to understand that model makes any statistical software. It looks at historical data. It looks at the implied data. It learns on the data, right? It trains on the data. It learns on the data. It has this artificial intelligence built inside of the MATLABs and R scripts. And then it makes forward-looking prediction. But it has no idea what the results of the iPhone sales will be. And when they do come out and stock sells off below 145, the model will have to adjust. So when this event happens, that's based kind of on implied volatility. It's based on the future data, the band or support and resistance lines will have to expand. And it's not only relevant for Tradespoon model. It's relevant for any statistical software, for any signals that you learn throughout these presentations today. It applies to all of these presentations. You have a signal based on certain patterns, but that signal relies on certain historical data. There are always going to be these outliers, right? We said there's one standard deviation move, 2 standard deviation move, but there's always events that we call outliers, and you have to account for them. And the only way to account for them is to make sure you trade small and you trade often, that you don't overexpose yourself in any given single trade. So historical implied volatility, let's see some examples. How can you determine historical implied volatility? Let's go back to our charts. This is our trading block. You can see the disclosure of Tradespoon and trading block relationship that I already covered in the beginning of the presentation. But you can go to volatility chart. And again, most broker-dealers, just like probability calculator, you can go to any broker-dealers and look for volatility chart. And you will see two types of volatility, historical volatility and implied volatility. So you can see, this is Apple, how implied volatility during the earnings event, right before the earnings event, volatility spikes. Or if there is a geopolitical event, like in the beginning of January, if there is a China defaults on its debt, then the volatility spikes. Or Apple announcing earnings. You can see volatility has been rising going into September into events of A, earnings, next earnings announcement that will happen in October, B, the announcement of the iPhone 8. So volatility is building up. That means the range, the bands, the Bollinger Bands, or any Ichimoku bands, or Tradespoon bands, they're expanding, right? There's more uncertainty about this event. Volatility is expanding. So this green line is implied volatility. The blue line is historical volatility. And you can see there usually sometimes they trade in tandem. Sometimes implied volatility is higher than historical volatility. Usually if you come into an event, implied volatility will be higher than the historical volatility. And then after the event, after everybody knows what the earnings announcement of Apple will be, or after a week that people know what the sales of iPhone will be, then you'll see implied volatility dropping and trades below the blue line. So to answer the question whether you are trading credit spreads or you trade in debit spreads, that is the usual answer. If I see that volatility expands, and I'm looking at the green line, if I see the green line expanding, that's the implied volatility. Usually that's where I would sell. If I want to express my bullish bias, I would sell credit put spread. Implied volatility expands, that means options are more expensive. Doesn't make sense to sell something that's expensive, right? When you buy insurance, you buy insurance before hurricane. If you want to try to buy insurance and everybody knows that hurricane is coming to Miami, the premium for the insurance are very high. At that point, you're too late. You can sell the premium, that's what the insurance company would want to do, but you do not want to buy when everybody expects the hurricane. You want to buy when nobody expects the hurricane. Trading is the same thing. If you see implied volatility expands building up to the event of the earnings event, you want to sell premium. You want to sell your options. You want to sell your futures. Once the event takes place and there is no uncertainty, that's where you want to build your debit strategies. You buy calls, you buy puts, you buy debit spreads. But before the event, you want to sell premium. So that's why implied volatility rank is important. It helps you with the decision whether you sell option premium or you buy option premium. And you should always look at historical and implied volatility, and you'll see that implied volatility is very cyclical, right? There's a true seasonality to that, and it's always goes in these ups and peaks and valleys. And the peaks usually corresponds to micro or macroeconomic events. I can look at any implied volatility curve and right away says, well, most here probably Brexit occur, or here it's an earnings announcement, or Donald Trump winning the election. So there's some kind of an event that corresponds to these peaks and valleys, and everybody's looking at VIX, right? VIX is that measure of uncertainty. Looking at the S&P puts, how many people are buying hedge when there is uncertainty. You can see VIX is the same thing. It's a volatility, and it shows you if there's uncertainty in the market, it spikes. So you always have to look at the implied volatility to see, maybe if you only do debit strategy and you see implied volatility expands, then just don't trade. Stay on the sidelines, because there's a lot of uncertainty. If you're buying stocks, if you're buying puts and calls, most likely you will lose money. Because most people who are making money when volatility is high are the people who are selling the premium, selling the options premium. So probability of success, the idea is that high probability of success, meaning low return on capital. If you trade in options, if we're going to go back to our probability chart, you can buy a call, right? You could buy 150, you could buy 172 call, right? But there's only 20% probability. That call might cost you only a dime or a quarter. So it's very cheap. It's very low return. There's very low probability of success, but there is a high return on capital, right? If Apple all of a sudden jumps to 145, 175, well, all of a sudden you made $3 and you only invest 25 cents. And that's why most of the new traders that trade options, they actually lose money. Statistically, 70% of the people and 80% of the people who trade options, they lose their money the first year. And this is probably #1 reason why. Because the 172 call, which is way out of the money, and you don't look at the statistics, you don't realize, well, only 1 out of 4 times it will reach that level. But it's very cheap, right? It only cost me 50 cents. So people gravitate towards something that's cheap without realizing the probability of stock reaching that level is very low. So this is probably the one thing you want to take out of this presentation. I mean, you guys been here since 9 o'clock in the morning, so there's no way you can learn more than 3 things. So out of my presentation, I'm hoping you're going to learn one thing, that that you can use probabilities to estimate where the stock or any underlying asset can trade. The second thing, if you want to get into options, because options give you leverage, and options, with a smaller portfolio, you can achieve 20% return, 50% return, 100% return. One thing you want to learn too, that ultimately probability of success and return on capital are inversely correlated. So if you want to buy cheap options, you can be greatly rewarded, but the probability of that event is very small. And you just need to be consistent in your strategies. There are some people and there are some services that want to buy cheap options, and it's like winning a lottery, right? 1 out of 10 times you'll be right, but all of a sudden you make your 200, 500% return. You just need to understand that if you were profitable once, that doesn't mean you're going to be profitable 9 out of 10 times. That doesn't exist, right? Just like a winning lottery, you can win a lottery, but you cannot win lottery 9 times in a row. That will never happen. So strategies is perfectly fine. There's some, you can look at Ichimoku Cloud, you can look at the unusual option activity and make several trades, small trades. You trade often, you trade small, and you don't need to be right 9 out of 10 times. You need to be right maybe 1 out of 10 times. But in that one time, you're making 400% return or 100% return, and the rest of the 9 times hopefully you're losing less than you made when you were right. But you need to make sure you consciously ask yourself, run through probability calculator using your broker-dealer and say, what is the probability of Apple reaching 172 level in the next 50 days? And if the answer is 20%, just be consistent. If you want to always buy out of the money options, great, but just write a trading plan that can actually make sense and can be a successful trade. If you're not comfortable being right 1 out of 5 times or 1 out of 4 times, then perhaps maybe you should buy 150 call, right, in the money call. Because 150 call, you're going to be right 70% of the time. 75% of the time, Apple will trade above 150 level. So higher probability of success, low return on capital, low probability of success, high return on capital. And you just need to make a decision which one you prefer. And the next thing, as I said, based on the 7 pillars of successful trading, it's very important. It's very important to look at the return on capital. And you can find this return on capital calculation. We actually do show it on our site. So if you go to our performance, we're very transparent about our performance. As I said, for premium picks, we trade option spreads. You can see how many winning trades we have, how many losing of the trades we have. There's, you can get comfortable. You can see we actually had very strong performance in the past 18 months. You can see winning trades, you can see losing trades, but more importantly, you can look at the view, right? You can go in and see any given trade, and I trade spreads, and more importantly, you can see the video of why I'm making these trading decisions. What tools I'm using, and here you can actually see implied volatility calculations. What the ID rank is with this recommendation, what the probability of success is. So we talked about probability of success move and return on capital, right? We talked about return on capital. Before you get in a trade, this is the Boeing. We did this trade on July 31st. We recommended the Boeing. I bought 230 call. I sold 235 call for $3.80. And right away, I was doing a calculation that my maximum loss is $3.80. My maximum gain is $1.20. So we do these calculations on your behalf so you can watch them. If you trade in stock, option, doesn't matter, you need to have the same calculations. If you trade in stock, you rely on the stop price as your maximum loss, but you have to do these calculations. And for credit spreads, if you do in the credit spreads calculation, like implied volatility is high, you sell in the credit put spread, then your maximum gain is always the credit you receive upfront, right? You look at the bid of your sell order and the ask of the buy order, you take the difference, that's your maximum gain. Your maximum loss is the difference in strikes, like we saw in Boeing or in this example, and minus the premium that you received. So that's your maximum loss. I know in this Boeing trade, I cannot lose more than the difference in strikes, which is $5, minus the credit that I received, $1. Well, this is a debit spread. But if it was a credit spread, minus the credit that I received. For debit spread, very similar calculation. Your maximum gain, as we said, it's different in strikes, minus the debit that you paid. So the maximum which you could lose in a debit strategy, when implied volatility is low, we're doing debit strategy, we're buying options, we're buying more expensive options because they're cheap when implied volatility is low. Your maximum loss is the debit that you paid, and your maximum gain is the difference between the strike price minus the debit that you paid. And as I said, using the estimated move analysis, you can determine range where the stock trading is for any stocks. So, you know, let's go an example. Let's do trade analyzed options. Type in Apple. If I want to know where Apple is going to trade by end of the week, I'm going to go pull up a chain, go to the next week expiration, look at the money options, and let me see if let me pull up my magic pen. Right, so I can look at the money options. Stock is trading at 158. I'm looking at 157.5 call, you know, at the money call, and I'm adding the straddle. So I'm taking $1.99. I'm taking 355. It's approximation. So $2 plus 3, that's 5. 5 plus $1, it's 6. 6 plus 2 is 8, and I divided by 2. So $4. So approximately by next Friday, the Apple will trade either at 153.5 or at 161.5. And you could do this calculation for the next week, for the next month, any type of asset class that has options, future options. Then I know exactly where the stock, not exactly, but I know with the, again, 68% probability in what range the stock will trade. And then if you see Apple reach 153 sometime during next week, potentially that's a support, and that's where you want to buy Apple because of this estimated move analysis. So I kind of quickly went over this. So again, this is estimation formula. You look at the option chain, and again, you look at the money put, at the money call, you add out of the money put, the strangle out of the money call, you add these four numbers, divided by 2, and this is approximate range where the stock or index will trade based on the expiration date that you selected. So again, very important to, we started this presentation with a trading plan. So a Tradespoon, I'll briefly show you the performance, but we are assuming that the performance that you saw on your screen assumes that you manage a $10,000 portfolio. I advocate not to put more than 5% of your portfolio per trade, which is $500. 5% of 10,000 is $500. Usually that could be 1, 2, 3 contracts of options that you buy. Average holding time is 30 days. We look for 20% return. We do trades that are, as I said before, we're able to achieve 80% probability, 80% success rate. So if you're correct 4 out of 5 times, if you're correct 4 out of 5 times, and you're looking for, I'm looking for 20% return per trade, you can see that if you invest 20% of 500, the profit is the $100. Even if you trade once a week, right? Even if you trade once a week, you have 50 trades a year, that can translate to $5,000. So 50% annual return on your investment. And you can see here, if you look at the performance, we kind of follow our plan. If you trade options, it's 64% return. Option spreads 40%. This is not cumulative, right? I assume that you started yesterday or tomorrow. You're not reinvesting your gains. So if you do cumulative returns, this is much higher. But you can definitely achieve the returns based on the strategy, and this is something that we are providing at Tradespoon. So I do want to go over the question, but I do want to mention the offer. As we said before, using this tool, Stock Forecast Toolbox, you can analyze any stocks, ETF, future, currency. You can look at our company screeners. You can look at the short-term trend analysis, support and resistance levels. You also will be able to see every day we will give you 3 bullish and 3 bearish ideas. So every day we're posting 3 bullish and 3 bearish ideas. As I said, different models behave differently and they have different level of accuracy predicting them. But you'll be able to go in and before market opens, we will tell you, bullish ideas, bearish ideas, and we'll give you the entry levels. The entry level 1, entry level 2. We're giving you a trading plan. You can view our trading plan if you review the trading room recording, or if you review Strategy Roundtable. First thing, if you guys are interested in the 7-day free trial, no credit card required. You just go to Tradespoon.com, right? It's very easy. You go to Tradespoon.com, and you register for 7-day free trial. Let me log out now. But if you click on this launch dashboards, it's a 7-day free trial. You basically get 7-day free trial, and I encourage you, as I said, different stocks predicted with different level of accuracy to trade stocks that we recommend, which you can see here. Gilead, on Monday we'll post new stocks, and in that trading plan that we are showing you, first look at the recordings, look at the Strategy Roundtable recording, look at the trading room recording. It will explain you what this entry 1 and entry 2 is and what exactly the trading plan, and just paper trade. See how accurate these levels that we are predicting are. And you have 3 bullish, 3 bearish ideas. We also, if you look at the Strategy Roundtable, it will show you the Stock Forecast Toolbox and this recommended list of stocks. That's where I would encourage you to start first, right? And then once you feel comfortable, then you can plug in any other stocks that you wanted to pick, right? But these are the list of like Adobe, Bristol Myers, Deere, NVIDIA. These are the stocks that model does excellent job in predicting, and you can actually go in and look at this model grade and statistics. So we have 3,000 stocks that we analyze, and A's and B's, meaning that we have statistics and we have high probability signal that the low and high will hold based on our numbers. So again, you get specific entries, specific exit prices, you get trend indicators, short-term trades, long-term trades, and it's 7-day free. No credit card, no commitment. Go to Tradespoon.com. If you like it, send me your feedback. Hopefully you become a long-term member. If this is not what you were looking for, I completely understand. All right, so questions. So Andre, what about probability out of the money? Right, so out of the money, as you were looking at our probability calculator, it's the same idea. So the question was, how do you calculate probability of out of the money stocks or options? So if you go to Apple, Apple is trading at 158. If you look at out of the money call, 172 call, here's the probability, 20%. And we're looking at 1 standard deviation, 2 standard deviation. If most broker dealers allow you to put any implied volatility, any strike price, and it will tell you what the probability in the money or out of the money options. Is Tradespoon as well as brokerage account or just trade support platform? So good question. Tradespoon, we do have, if you look at the bottom of the disclosures, it shows you the disclosure between Tradespoon and Trading Block. I am an investor in Trading Block, and we do have auto execute service. So if you want to auto execute these trades, these expert picks that I showed you here, expert picks trade, we have two services: live trading room, this is day trading, and short-term trading, like we trade weekly options, stocks. Expert picks is more of a swing trading. Usually I hold the position for 20 days. You can auto execute them via Trading Block. So Tradespoon itself is just analytics platform, but we do have integration with Trading Block, and you can auto execute and you can manage your portfolio via Trading Block. So thank you for the question. What is Trading View, Matt? Trading View, I don't know where you saw that. Oh, Trading View. If you go, these are charts brought to you by Trading View. Great platform. This is another freebie that you guys get in, but these are where we're getting the charts. So the charts that you saw on Active Trader, these are just a snapshot chart of, this was, Gilead Science was the pick for Friday. So that chart is by Trading View. It's just a static chart. Thank you, Matt, for the question. What is the cost to be a member? You can go to pricing page, and you can see the prices. So it's 120. Stock for Request Toolbox $127 a month, Premium $197 a month, and Tools is $147 a month. But again, for the 7 days, you get it for free, which is a great thing. So in terms of our new models, somebody asked about integration with Metastock. I'm very proud to announce this. We spent a lot of time and energy between me and Jeff trying to get this to work, and we're almost ready to launch. We're probably going to launch in October. You can already see that we have full integration with Metastock, and you can type in any stock, you can scan any exchange using Metastock software, and when you type in, here's I'm showing Abbott, we're going to show you whether we have a buy or sell signal. We're going to show you 10-day support, 10-day resistance. Very important for stock option trader, right? We want to know where the stock is going to trade. With our proprietary software, we're going to give you that level of support for the 10 days. We're also going to give you 1-day support and resistance. I don't care if you're a day trader or if you're a long-term trader, you need to, when you're ready to pull the trigger, get into position, you do not want to buy Abbott when it reaches 51.94. You're going to overpay. On Monday, if you want to buy Apple, I suggest wait and be patient and buy Apple when it's Abbott when it's close to $50.76. The difference between $50.76 and $51.94, what is it? $1.20. $1.20 on the $50 stock. We're talking about 2%. You have to be frugal. You have to be frugal when it comes to your cost basis. And trading options and statistics is all about reducing your cost basis. You want to buy stock at on sale. So what Tradespoon allows you to do using the Metastock software, it allows you to know, are you overpaying for stock or are you paying a fair market value? So if you're a day trader or if you're a long-term trader, if you can save 1 or 2% on entry and 1 or 2% on the exit, I don't care what type of trader you are, how long you hold your position, this will make a difference between being a profitable trader and non-profitable trader. So I encourage you to look at, we're going to launch this in October. Again, we're going to give 30-day free trial for any Metastock user. And if you're a Tradespoon subscriber, we'll give you this for free. And you will be able to basically scan S&P market, scan NASDAQ, scan Australian markets, scan European markets, and find this the buy or sell signal. And more importantly, on U.S. stocks, you will actually determine the model grade, which can help you determine what is the probability that if we're predicting the low, that the stock will actually trade at the predicted low. So Andrei, thank you for the question. All right, Michael, can be used for intraday E-minis? Great question. Yes. So if you are going, so the question was, if I'm trading E-minis, is this useful tool? Can I day trade E-minis? The answer is yes. I trade E-minis myself. I trade futures on E-minis. We do have intraday predictions. So when the market opens on Sunday, right, Sunday at 5 p.m. Central, when the market opens and you're actually going to see the data, we will give you predictions of where the market, the predicted low and predicted high for when the market opens every 5 minutes. And same idea happens. If you see the trend, you want to, when E-mini opens, you want to buy it at 2462 and sell at 240.63, because the model will do, right now the market is closed, but when the model open, especially due to hurricane, everybody will, by that time, hopefully the damage is minimal and you're not going to see a lot of volatility. But if the hurricane remains in the same force, there could be a significant sell-off in the market, and you definitely can look at the 5-minute predictions to determine where the S&P Mini will trade. Michael, thank you for the question. Matt, in terms of Oracle, so if you look at Oracle, very good question. Why does it say sell? So the buy and sell signal, this is automatic formula. So if you want to basically do a black box trading, right, and basically follow our signals, on Oracle, we have a buy, right? We have a positive vector. We're predicting that Oracle is going to go up on Monday. We're assigning model grade. Then the question Matt has, why does it say sell? What the model basically says, it doesn't say, excuse me. Sorry about that. Enjoying the good weather here in Chicago, and but anyway, but what the buy and sell signal means, it doesn't say buy on Monday and sell on September 21st. It's not what this model is trying to do. What the model is trying to do, it basically tells you that you want to buy when the stock reaches the low. And here, 51.58 seems to be the low. But if the stock reaches 52.98, or if the stock reaches 54.07, that's most likely is overbought for Oracle, and that's when you want to sell. It doesn't mean that it's going to happen on September 21st. It might happen on September 12th. But the idea that when you look at this 10-day support and resistance, right, you want to sell at the upper band and you want to buy at the lower band. That's what these buy and sell recommendations mean. So thank you, Matt, for the question. I think I covered most of the questions. 507. Jeff.
Good job.
Thank you. I'm hoping I answered all the questions. If I did not get a chance to answer one of your questions, do me a favor. You can go to quick navigation here. Hopefully everybody here will open up a free account, right? Because it's free, and why not?
Should try
it. You can try it. It's tradespoon.com. But if I did not answer your question, just open up a dedicated support, type in your question, and I'll make sure that I'm going to answer your question if I didn't get in. And again, this is a 7-day risk-free trial, no credit card, no commitment. Go to tradespoon.com, and hopefully you will take advantage of this offer. Jeff, thank you very much for having me. Sorry,
thanks for coming today.
I talked a little bit too long.
It is okay. I told you, it was okay.
It's good to be less, right?
Good job. The thing, we've been kind of working with this for a while, guys, and I really like the fact that Vlad and his programmers have actually put a lot of this stuff in Metastock, and the fact that they're just going to offer it for free to all of their subscribers, all you have to do is have a membership to their account. We were hoping to have it ready by today, but it will be ready, and we will release it when it's ready, right, Vlad?
Yes.
And not before. So hopefully it'll be ready within the next few weeks. But I'd encourage you, there's some really interesting stuff up there, and I'd encourage you to try the 7-day trial. So, Vlad, you did a good job.
Thank you very much. Thank you for having me. I had a lot of fun.
All right.
Hopefully everybody else did too.
Very cool. All right, guys. I'm going to go ahead and take back over here. Let's go ahead and just take a little bit of a breather. That's been a long day. I want to remind you of the offers. I really appreciate we've had a ton of people signing up today. I'd encourage you, if you're interested in kind of like what you saw today, between Bigelow and Kirkland and Sadler's, 3 of our best add-ons that you get take advantage of the toolbox. Again, it's $899. Most of that, all but $59, is available on a money back guarantee. Normally, if you bought everything, you're gonna pay $12.97 just for those. You get the 2 years of stocks and commodities, which you get regardless of whether or not you keep Metastock or not. You get 3 months access to Metastock. The boot camp I'll be running on September 21st at 6 p.m. You'll get Unleash the Power of Metastock as well. If you add up all those costs, it's $1,722. $899 is what you'll pay to get probably three of our best add-ons that we offer. So, and again, 30-day money-back guarantee. Give us a call, 800-882-3040. If you have questions that I didn't answer or I didn't answer well enough, go to our website or go to metastock.com. It's our sales chat, and you can talk to our guys, and they can kind of explain any questions that you might not have. And I do want to just kind of also talk about our sponsor, Stocks and Commodities. I've said it all day long. Great magazine. Very, very good way to kind of make sure you're committed to improving your education, knowledge around the market. They've been published in the magazine since like 1982, and definitely the magazine for technical analysis. I'm missing an adjective, but we've been here for 8 hours, so, a great magazine. The epitome of technical analysis magazine. So we're also going to talk a little bit more about Metastock. I'm going to stick around and answer any questions that you've got, but it does allow you to scan markets, test trading ideas across multiple markets. Let me send that to voicemail. Get real-time alerts. And, if you don't want to do the package I talked about that included everything, also includes Metastock. But if you want to just do Metastock by itself, you can do it for $59 a month. Again, it's been the winner for the Stocks and Commodities Reader's Choice Awards every single year since 1992. I'm so proud of it. It's definitely a toolbox. It's a huge toolbox to help you in your trading. And just give our guys a call, 800-882-3040, or chat online with them at metastock.com/saleschat. There are a few questions coming in. Ashok says, I didn't really, excellent day of learning. Whew. Trey says, great job. Michael says, thank you. Ashok says, $8.99 is valid till September 21st. I didn't actually put a deadline on the offer, but I would definitely encourage you to take advantage of it by the boot camp. I did want to give you some time to do some research if you wanted to. It's a very low risk opportunity anyway. But yeah, up until September 21st. I would do it before that boot camp, and I'll try and give you a really good class. 3-for-1 basically is if you just want to do Metastock Ashok, what you can do is you can pay $59. And that doesn't include like the add-ons or anything like that. That includes Metastock. I was going to say just includes Metastock, but Metastock, is a great program all by itself. And basically what we'll do is we'll have you pay for 1 month of Metastock, and we will give you 2 additional months. It's a good low-risk way because literally 3 months, that's December 9th. So by the time that $59 trial is over, you're going to be buying Christmas presents. So it's not that far away, but that's the way the 3-for-1 works. If you do, Ashok, and just to clarify your next question, if you do the 3-for-1 offer, you're going to get that 3 months included in that $899 price. Okay. The difference between DC and RT, that's a really good question, Paulette, and I'm going to answer. DC, what DC stands for is daily charts. So in Metastock, you can do daily charts. You can do, in Metastock DC, you can do daily, weekly, monthly, annual, quarterly, et cetera, but it doesn't have any real-time intraday data. And it updates once per hour during the trading day, so it's not a full real-time package. That's why we used to call it Metastock end of day, but then we made some changes to the data service where most of the exchanges updated hourly, so we had to figure out something else to call it. Metastock RT is the full real-time version of Metastock. It comes with Metastock as well as another platform called Metastock Zenith that includes all kinds of news and fundamentals and information from Reuters. And so that's the difference.